So last week we did IFRS 5 non-current assets held for sale. Yeah? And I said to you that IFRS 5 deals with two things. It deals with non-current assets held for sale, which is, if you recall from last week, all about a reclass from non-current to current, yeah, reclass to current assets, and a remeasurement, because these assets are now no longer being used, and so the future benefits are the fair value that I'm hoping to sell them for, isn't it? And there's a remeasurement at lower of carrying amount and fair value less costs to sell. Because my intention is now to sell this asset, and so if the amount that I can sell the asset for is less than what I'm carrying it in the books at, I need to make an adjustment. And that's what we looked at last week. This week we're going to deal with the other aspect of IFRS 5, discontinued operations. Discontinued operations. And discontinued operations deals with, or is a statement that talks about the P&L aspect of when I have a discontinued operation. And it first of all defines a discontinued operations, and it says that it must be a separate component of the company. It talks about the fact that it needed to have been a major line of business or geographical component, not gig, I'm going to say, or geographical. So this discontinued operation needed to have been a major component of the business, and it needed to have been a major line of business or geographic component. Yeah. And this is where it's a little bit different to non-current assets held for sale. It needed to have been discontinued during the year, or there needs to be a plan to discontinue. If you remember last week, there were all these criteria, do you remember, that we talked about when we looked at non-current assets held for sale, and we said for it to be classified that way, we needed to meet certain criteria. This is those same criteria. Yeah. So the criteria need to be met. It's the same criteria that we had on that side over there, which included having a formal, detailed plan. Do you remember that's been announced to everybody, where discussions have already been held with employees, unions, etc., etc. Criteria needed to have been met for this plan to discontinue. But if we have a significant component of our business, which is either a major line of business, so I'm discontinuing the business colleges, or let's say I'm discontinuing the sports management or the law lectures, but I'm continuing with the rest, a major line of business, or geographic, I'm closing down a certain branch, geographic area, and it's either been discontinued already, so during the year I've closed it down, or I have a plan to discontinue. And for that plan to be met, I have to meet those criteria, isn't it, at year end. If I have those, then there's a requirement. IFRS discontinued ops is all about disclosure. If I have that, then I have an NB for disclosure. It's disclosure in my P&L. And essentially what I'm going to do if I have a discontinued operation is I'm going to take my P&L and I'm going to split it into two P&Ls. I'm going to have a continuing operations P&L so that my users can see what as what expenses, income, turnover, cost of sales, profit is going to carry on into the future, and I'm going to have a discontinued operations P&L. And this continuing and discontinued operations P&L is going to be for the whole year, and that's critical, very important to make sure that you get that right, because they will start to tell you about dates like they did for non-current assets held for sale. They will tell you that the management met and decided on this date, and then that the plan was finalized on that date. And they'll give you a whole lot of stories about dates. But dates don't come into the discontinued operations disclosure. We want to show our shareholders the profit that was earned this year, how much of it is going to carry on, and how much of it is not going to carry on. Do you agree that's the useful information for a user? The user wants to know, what do next year's sales look like? What are next year's sales going to look like? If I've discontinued half my business, I can only expect half to continue next year, isn't it? And that's got nothing to do with the date of this discontinuance. And in some cases, we wouldn't even have yet discontinued, isn't it? The plan might have just been put in place at year end. But for the next year, or maybe for the year after that, we know that a piece of our business is going to disappear. Okay, so there are two allowed models for disclosure. This is page 214 in your study guides. Two allowed models for disclosure. This one that you see on page 214 in your study guide, 214, you will see is two whole, just about whole P&Ls. So your normal P&L for continuing operations, revenue, cost of sales, gross profit, other expenses, finance costs, profit before tax, yeah. And then another one for discontinued operations. For discontinued operations, we don't need to show cost of sales, gross profit. We just show revenue and then all the expenses to get you to your profit or loss. So the important pieces here are revenue, because I want to be able to see how much revenue I'm losing, and then really the profit or loss. So we just go straight to there. It's a little bit shorter. What you also see in this discontinued operations is loss on. Okay, is this loss on remeasurement? Loss on remeasurement. This loss on remeasurement of non-current assets held for sale is the stuff we did last week, is that impairment that we had last week when we remeasured the non-current asset or the disposal group last week. Non-current asset held for sale or disposal group. We had an impairment. That's what we did all of last lecture, was work out these impairments, isn't it? This impairment that we had from last week, we show separately below the line, right, at the very bottom of our P&L. And we show the gross amount here and the tax implication that then ties up to a net. Because I'm showing it below the line, I'm going to do the tax on that item. So it'll be the impairment, the tax benefit of the impairment, giving you an after-tax loss. Yeah. So this impairment that we work out from last week of the remeasurement of our non-current assets or our disposal group in this discontinued operation lands up at the bottom of your P&L as a separately disclosable line, yeah, on the face. So if I go back to the very beginning here and I say to you, IFRS 5 deals with non-current assets held for sale and discontinued ops. When we have a discontinued op, we will always have a non-current asset held for sale or a disposal group, isn't it? Because I have a discontinued operation, and in that discontinued operation, there will be non-current assets that I'm selling, or the whole group of assets that I'm selling, isn't it? So discontinued operations always have non-current assets held for sale. But we could have non-current assets held for sale that have nothing to do with the discontinued operation. So if I have a business and I decide that I'm going to sell a property and then I transfer it, it doesn't need to have a discontinued op. It's just a property I've decided to sell. It's just this piece, isn't it? But if I have a business and I have a discontinued operation that I'm selling, it will have that piece. Yeah. So sometimes we do see an overlap, but the overlap is this way, not the other way. Okay. So the model is a whole P&L for continuing, a whole P&L for discontinued. In that P&L for discontinued, at the bottom is I do have something here. See, I see Pearl's passing you tissues. I have one of these. At the bottom of this P&L is that loss on the remeasurement. Okay. The other option, I said to you there were two options for this P&L, but this is the one that you're going to use because this one is the better one. The other option is to show your discontinued operation and just to show this number. Let me do it in blue. So just to show one line for discontinued operation. So show your whole P&L for continuing, and then for discontinued, show one line. Option 2, one line. But if you show one line, you have to show the note. You have to show it in a note. So it's not like it's less disclosure. It's just the way it's shown. Do you agree? One line and then a note. So instead of putting all of that on the face, you put it in a note instead. But I think that would happen maybe in practice because companies' P&Ls are big, isn't it? And so then they'll end up having to try and squeeze two P&Ls on one page. And rather than doing that, they show that as one line, and then in the note they show that information. So you are still disclosing it, it's just how you're doing it. For your purposes, our P&Ls will be short. There won't be masses of stuff. And so because our P&Ls will be short, you will be able to fit the two. And anyway, in exams, when this gets asked, they don't ask you to do both P&Ls. They just ask you to do the second one. So they say, do the P&L for the discontinued operation only, not for the rest. Okay. All right, so last week, we looked at this company, this example 13, which was Aqua. Do you remember it, Aqua? I showed you last week the notes for Aqua. Specifically this note, do you remember me showing it to you for disclosure purposes? The note of non-current assets held for sale, yes? And I said to you, this is the disclosure of non-current assets held for sale. This is what the note looks like. It was on page 218, yeah? So I showed you this note on page 218. And then I also showed you further on, example 14, which is also Aqua. But in example 14, they had a disposal group instead of a non-current asset held for sale. And then for this one, I showed you the disposal group note. If you recall, that was on page 224. Yeah? And I showed you those two notes. And I said to you, we're not going to look at the numbers in the notes then, because we're going to look at it this week when we actually do example 13 and 14, which is Aqua. All right, so let's start by looking at example 13. It's on page 215. 215, is that right? 215. And 215 says Aqua manufactures and sells water sports equipment. So like, I suppose, surfboards and jet skis and things like that. They have branches in Cape Town, PE, and East London. The East London branch incurred losses over the past 2 years, and on the 31st of March, the Board of Directors approved a formal disposal plan for the discontinuance of the branch, and on the same date made a public announcement. The approved formal plan was at a stage of completion on the 30th of September 2010, where no realistic possibility of withdrawal existed. Binding sale agreements were concluded. It's expected that it will be completed by February 11. The year end is 31 December. Do you agree? Criteria is met, isn't it? The Board of Directors approved a formal plan. They made a public announcement. The plan was at a stage of completion by 30 September, and there was no realistic possibility of withdrawal. Those were the criteria we talked about last week, isn't it? And you'll see that in this one, in example 13, they talk about a piecemeal sale of the assets. Piecemeal means one by one, in pieces. Okay. So then they give you the following information. The following information is presented to you. Here are the assets of East London and then Cape Town and PE. So East London has PPE, they have current assets, they have some long-term liabilities, probably to do with the PPE, like mortgage bonds or whatever, and they have some current liabilities, and these are the assets of East London branch. And last week, you would have done the work to do the impairment of those assets, isn't it? Do you agree? If we just skip down past where they talk about the operations, you'll see that over here they talk about the piecemeal sale of the property, plant, and equipment, and they say that the plant and the property have carrying amounts of 120 and 80, giving you the 200 that was in the front, isn't it? And that the price of those, the contract price, is 105 and 80, and that we have an impairment here. Right? This one is not impaired, this one's okay, but for the property we have an impairment of 15. Yeah? And that's what we would have done last week. We would have seen that impairment of 15. And if I show you that note again for non-current assets held for sale, the note says a decision to dispose of property and plant due to the fact that the branch incurred losses for the past 2 years was taken in March, and blah, the whole story. The non-current assets held for sale, because do you agree the other things there were current assets, current liabilities, non-current liabilities? They were not non-current assets held for sale. And it wasn't a group either, because they were being sold off one by one. So the non-current assets held for sale are the property and the plant, and I measure them at the recoverable amounts, 105 and 80, which is what we did last week. And then I talk about the fact that there was an impairment loss of 15 pre-tax that was recognized on initial classification and is included in the loss on remeasurement in the P&L. Yeah. So in our discontinued operations P&L, there's going to be that loss on remeasurement. Okay, so if that's to do with the assets, which is the stuff we did last week. So let's look at the stuff for this week. For this week, they give us the results. Okay, actual results of continuing operations. They give us for Cape Town and PE. And you'll see that they split all the dates. So they give us from January to December of the current year, and then they give us January to December of the prior year. And for the current year, 2010, they've split Cape Town and PE. Yeah? And then, so they give you income, cost of sales, and other expenses. And then for the discontinued operation, the discontinued op is East London. There, they split all the periods. So for the prior year, they just show you the full year. But for the current year, they do this thing where they split all the periods. So they go January to March, then they go April to September, then they go October to December, because they gave you all those dates in the question, isn't it? But the reason that they're giving you all that split is just to confuse you, right? Because it forces you, or it makes you think, oh, I've got to show those numbers separately, isn't it? But what was it that I said to you at the beginning of the lecture? When we have discontinued operations, we show the operation as discontinued for the whole year, isn't it? Because the purpose is not to show our shareholders what we've sold after we decided to discontinue. The purpose is to show our shareholders that we have made a plan to discontinue, and that certain income and certain profit, which is the number that you land up with, is not going to carry on next year, isn't it? So I want you, so that's the information. Then there's some more information that you need to just consider. It's over here. Discontinuance cost. There are some direct costs of discontinuing, actual costs that were incurred up to year end of 4.5, and then some that are estimated. These estimated discontinuance costs are the provision, or a possible provision, for discontinuing. Do you agree? So I've decided to discontinue. The decision is made. There will be costs that will be incurred. I'm allowed to provide for them now because I have the obligation, because the criteria is met. But I must just be careful that I provide only for things where there is an obligation. So if we look at them and we try to see which ones would be included and which ones wouldn't. Direct costs of discontinuance. I have an obligation, isn't it, for costs to discontinue this company. It might be things like cancellations of rentals, whatever, yeah. Cleanup, repainting the premises once I leave, those kind of things. The decision has already been made to discontinue, so the obligation exists. Do you agree? So this would be a provision, the 3. Severance pay that's payable to employees is a provision, isn't it? I've made the decision already. I've identified which employees. It's all the employees in the East London branch that will be retrenched. So I have an obligation. I create a provision for severance. Fines for discontinuing contracts is also an obligation. We're looking at it from FAC3701's perspective. I know some of you are doing them both at the same time. In 3701, when we have a provision, we ask ourselves, do we have a present obligation as a result of a past event? For all of these, I have a present obligation, and it's a result of a past event, isn't it? So the 3, the 20, and the other 3 would all be part of this provision. Then they've told us what income and expenses and cost of sales they're expecting to come through next year. That's next year's profit or loss. Do you agree? It's not this year's profit or loss. I don't have any obligation for those. If I don't sell them at all, then I won't have any income, any expenses, any profit or loss, isn't it? So it's only where I have a provision for the discontinuance. It's only where I have an obligation. So if I have an obligation, I would create that provision, isn't it? And so those numbers, I'm going to create a provision, and I'm going to put the expense into my P&L. Do you agree? It's going to go into my P&L as an expense. The plus the actual costs that were incurred, these 4.5 that will be actual costs, must also go into my expense. And I'm assuming that none of these are in the expense. They don't really say, they're not really clear, isn't it? What do they say at the bottom here? Nothing. Okay, so all of these costs must go in. Other information, finance costs of continuing ops, tax for discontinued and continuing, which is all current, and dividends paid. Tax was calculated before taking into account the finance costs and the direct costs to discontinue. We're going to have to fix tax. Do you agree? Tax is going to be your biggest bugbear when we do discontinued operations, because we have to do 2 tax calcs. We have to show tax twice. So the tax has been calculated, but it isn't correct. It needs to still be fixed, isn't it? Then the other thing is that this needs to be split for continuing and for discontinued operations. Because if we look at our model, this was our model over here, you'll see that we have a tax expense here for continuing ops, and I have a tax expense here, or a tax benefit here for discontinued ops. Yeah? All right, so for that alpha example, I want you to set up a template like that, continuing and discontinued, and I want you to start brackets over there and to start putting numbers in from the information given in the question. So I'm going to leave it on this page. I want, by the time you're finished, I want 2 P&Ls. One for continuing operations, one for discontinued operations. Okay, let me see if you can do that. I see the P&Ls are right there. You can see them, isn't it, on the next page? But try to do them by yourselves. Okay, shall we have a look? Solution page. Okay, so the continuing bit should have been fairly easy, am I right? Cape Town plus PE. So Cape Town plus PE should be all the numbers, pretty straightforward. Is it? Was it just the 2 added together? And then finance costs, they gave you later. So those ones are there. And then tax, they did a calc, a separate calc. But I want to show you a tip for doing tax if they don't ask you for the tax note, if they just ask you to do the P&L. Do you agree from FAC3701 that because of the way I account for tax, because of the way that I account for deferred tax, that this number, let me rather use a highlighter, that this number here, no, that one, that this number here, oh, for goodness sake, this number here times 28% should be my tax. It's a combination of current and deferred, isn't it? And the only exception would be exempt items. Yeah, so unless they are exempt or non-deductible items, permanent differences, then 228 times 28% should be my tax number. And does that work out? So instead of doing a whole tax calc, you just do that. Yeah, because it doesn't matter if there are differences with wear and tear and depreciation, if there are prepaids or advances, those get washed out with deferred tax, isn't it? So deferred, so your tax line in your P&Ls for discontinued and continuing operations is just your profit before tax adjusted for permanent differences times 28%. If you need to do a tax note, then you need to go do tax and deferred tax because you need to know how much is current and how much is deferred. But if they just ask you for the P&L, then you don't have to. Okay. So this top continuing operation P&L should have been straightforward. Do you agree? And they won't ask you that in the exam. Okay, because in the exam they like to ask this bottom bit, the discontinued operation, and when you look at the discontinued operation, your revenue should have been the revenue of East London for the whole year. Do you agree? So if you look at that number, 235, it's 100 plus 60 plus 75, the revenue for the whole year. Then the expenses would have been the expenses for the whole year. Cost of sales plus other expenses. So 60 plus 20, 80, plus 70 plus 30, another 100, 180, plus 45 plus 20, 245. Do you agree? And then we need to adjust for those extra expenses that they told us about. And so when we look at those extra expenses that they told us about, we're having to add on, let me just find the calcs, No, I don't see that calc. We'd have to add on the 3, the 20, the 3, and the 4.5, yeah, which I had in my story. So if we look back, the expenses or total expenses for the discontinued operation are these numbers at the bottom here, which came to these numbers at the bottom here, those ones, which came to 245, yeah, plus on this page, these numbers here, 245 plus 20 is 265, plus 4.5, 269.5, plus 6, 275.5. Is that what it works out to be? 275.5, and that's the expenses, the total expenses. It gives you a loss before tax. Often with discontinues, it will be a loss. Otherwise, you have to question, why are you discontinuing an operation where you're making profits? It gives you a loss. And then what you can see from the tax is that the tax is again, or should be again, if the things are all tax deductible. Did they say anything about things that weren't tax deductible? No, I don't think so. All the items will be tax deductible. No, they are not.
It said the direct cost of continuance is tax deductible. Assume that severance pay and fines is not deductible.
Not deductible. Okay, so in this number, 4,500, which is starting as a loss, there are things that are not deductible. A 20, do you agree? And a 3. A 20 and a 3, which makes my loss smaller. Do you agree? I'm reversing the deductions, the losses. So it makes my loss smaller. It makes my loss 2,300. Now, if I take that and I times by 28%, I should get that number, 2,300. Somebody do that for me. Does it work now? Okay, so here's that example of what I was telling you about doing a quick tax calc. The quick tax calc is to take my profit or loss before tax, adjust for only the permanent differences. So there are expenses in that number that are not deductible, so they get added back. I'll end up with the number that would be current and deferred, and times 28, it lands up being my tax expense. Then that 15,000 loss is down here. Remember, we worked it out last week or earlier, and the tax on that is a straight 28%. It's an impairment. It's also deferred tax, isn't it? I'm writing down, I think it was property or plant, one of them. I think it was property. A straight 28% on that. When you look at, and that would be then your P&Ls. And the aim, if you're doing a P&L, like I said, is to try and get your tax number calculated quickly, a little calc. Because if you look at their tax calcs, they have a tax note which splits the current and deferred. Yeah, but if you haven't been asked for a tax note, then you don't need to worry about it. Their tax calcs look like this. They first do a tax on continuing operations, a tax calc for that. Then they do a tax calc for discontinued operations. When we do the discontinued operations, there are some permanent differences, the 23. There's also temporary differences on the provision, because that provision will only be allowed as a deduction when I spend the money. Do you agree? And then I have a deferred tax calc, which is on that provision. Here's the deferred tax calc at the bottom, and the movement, and everything is like done twice over. 2 deferred tax calcs, 2 deferred tax movements, 2 tax calculations, isn't it, to add up all the numbers. But remember, if you're being asked only to do the P&L, which is normally what you're asked to do, you're going to do the quickest possible tax calc that you can. And you're going to do one which says current and deferred tax together should be the profit before tax times 28%. And except if there are any permanent differences, exempt items, non-deductible items, and those I would adjust. Okay, so do you agree that in the 4,500 there's an expense of 20, making the loss bigger? I'm going to make the loss smaller, and there's an expense of 3, making the loss bigger. I must make the loss smaller. I make the loss smaller, it comes down to 2,300, and at 28%, it's a tax benefit of 4,900. Yeah. Okay. So that's essentially what they ask you to do. What you can see in the next example, example 14, if I show you, the only difference with example 14 is that they say to you that it is a once-off sale of assets and liabilities. So in this case, it's a disposal group. I'm selling a whole group of assets. When I look at the information about the disposal group, it's here. Here. The assets and liabilities met the criteria to be classified as a disposal group, and the fair value less costs to sell was 49. So they have to do a calc to work out the disposal group loss, isn't it? Is the calc here? Carrying amount of the disposal group is made up of the PPE, the current assets, the long-term liabilities, and the current liabilities, and the provision for discontinuance is in that disposal group. Provision for discontinuance. Fair value less costs is 49, and so the write-off is also 15 in this case. Yeah. And when you look at the P&Ls then, I just wanted to check that that number was the same. When you look at the solution for 14, the P&L piece is the same as the solution for 13, isn't it, the P&L piece? And the only difference between 13 and 14 is one, the assets were being sold individually, the other one, the assets were being sold as a group. Yeah. All right. So that's the whole calculation. I wanted you to practice one that was a past exam question, and I went to make copies for you and struggled with the copy. I kept making them upside down or cutting off. It's a question from October 11. But the question is for 50 marks. It's not all disposal groups. Yeah. October 11, there was a question for 50 marks, 50. In those days, 50 marks was 60 minutes. Now it's 90 minutes, hey, because your exams are an hour longer. So your exams are 3 hours for 100 marks. So a 50-mark question would be 90 minutes. If we look at the requireds, there's a whole lot of information. Here's the requireds. I think I only put the one required in. How many requireds do you have? 2. The first required is the required that I want you to do today. It's to prepare a statement of P&L only for the discontinued operation, according to IFRS IS 1, IS 12, and IFRS 5. Present the detailed analysis of the discontinued operation on the face of the P&L. Remember I said to you there's the option to show a face or to show one line and a note. They want you to do it on the face. Normally that is how they want it. And they say that you should calculate deferred tax using the statement of financial position. But I don't think you need to do that, because if you can get a number, that's all it is. Hey, it's a tax number and it's 1 mark. All right, so that's worth 18.5 marks. 18.5 marks. Then the rest of the question was some notes, a PPE note, an investment property note, and the non-current asset held for sale note. 31 marks, a third of your paper for the PPE, the non-current asset, and the investment property note. Yeah. So I want you to just focus for now, for today, on the first part of this question, the 18 marks, the discontinued operation. If we just look through the question, the company is a property company. They have a number of properties. They have a property in Bedfordview. They have a property in Struisbaai in the Western Cape. This property in Struisbaai in the Western Cape is the one that's being sold. Yeah, is the one that's being sold. And they have a motor vehicle. There's impairment, I think, on the motor vehicle, but you don't need to worry about that. The related income and expenses of the 2 properties, here in note 3, for Bedfordview and for Western Cape. Do you agree that it does meet definition of a discontinued operation? Because they are a property company. If they were a manufacturing company and they had a property in Bedfordview and one in Cape Town and were selling the one in Cape Town, it would just be one of our assets that we're selling, isn't it? Because they're an investment holding company, that's how they earn their money, from rental income. Then they have a property in Bedfordview and a property in Western Cape. The Western Cape one is being discontinued. So I want to see a discontinued operation disclosure. Most of the marks, I imagine, are going to be in the impairment piece for that one line, isn't it? That loss on remeasurement. Because you're probably going to have to do some work on this Strathspey property. Let's see. The property was purchased February 10 with the intention to earn rent from it. So it was an investment property. Do you agree? The return on the properties did not meet management's expectations. They decided to sell the properties. A detailed plan. Here's the fair values of the lands and the buildings at the various dates. Yeah. So you going to have an adjustment there. Okay, so just that P&L. Let's see what else is here. But they're talking about depreciation. Owner-occupied property is accounted for using the reval model. Investment property is accounted for using the fair value model. It's not owner-occupied, right? Because we earn rent. Property investment company. The Bedfordview one is owner-occupied. The Cape one was the investment property where we earned rent. Okay. What else was there? SARS allows some capital allowances. Tax rate was 28%. And they give you the deferred tax balances for the different properties at beginning of year. Okay, so our year end is June 11. June 11. All right, 18.5 marks. It should be doable. We'll practice that. So I want you to do the P&L first because it's this week's work. Then if you have time, if you're done, you can do the non-current assets held for sale note, which is part of required B, which was last week's work. How's it going? It was easy. Okay, so most of it should have been easy. Revenue, it's just the two periods added together. Other expenses, the two periods added together. Finance costs, the two periods added together. Do you agree? Then we have this thing with this property. It's an investment property. What was the rule last week with assets carried at fair value? We don't write them down to fair value less costs. We just keep them at fair value, isn't it? So if you looked at the fair value of this asset, it needs to be transferred, but it doesn't need to be remeasured. Because remember, last week, all our assets that we had at fair value, we excluded from remeasurement. So this asset, non-current asset held for sale, would have started the year on 2950. At the 31st of January, we would have transferred it to non-current assets held for sale and remeasured it at fair value. There would have been an increase of 16. And then at year end, we would have remeasured it again at fair value. And there would have been an increase of 13. Why? Investment properties get transferred, but they don't. They're excluded from the measurement rules, the remeasurement rules. Assets carried at fair value are excluded from the remeasurement rules, according to last week, isn't it? So this 16 and 13, 29, is not part of the IFRS 5 remeasurement rules. It's part of IAS 40 investment properties, which says investment properties are carried at fair value. So the 29 is the fair value measurement of the investment property. You could have said that it's this movement, because that's what it was at beginning, 2950, and at end it's 2979, 29,000 increase in value. Yeah. So if we look at our P&L, That's that 29 there, increase in value. So I said it was 16 plus 13 because I split it, but you didn't need to split it. You then land up with profit before tax of 32. 32. Tax on the 32. We're looking for exempt items, isn't it? When we look at exempt items, we know that the only exempt piece is the capital gain piece, isn't it? That's what would have landed up in our recon, the capital gain piece of the 29. So I start with 32, I put in the fair value adjustment of 29, but only the exempt piece, the 33.4%, because that 29 movement, increase in value of property, would be taxed capital gains 66.6, isn't it? The rest, 33.4, is exempt. So I remove the exempt piece. So I do a quick tax calc. I start with 32. I put in the exempt items, which is the capital gain exemption on the 29, which is 9,686. I land on 22,314, and at 28%, I get 62,48. If you have time in the exam, you can go and do all the calcs, isn't it, that they asked you to do. But if you don't have time, you don't have time. I don't know, I can show you the calcs. So that gives you the 6248, and that's the profit for the year. The example we practiced, Aqua, then had a line there that said loss on remeasurement IFRS 5, isn't it? I don't have an IFRS 5 remeasurement because I have investment property. So that line is not in this P&L. I've written here, no IFRS 5 remeasurement. Assets at fair value are excluded from the remeasurement rule. If you look at their calc, they start with a tax calc where they start with a 32 and they remove the fair value of 29, because at the moment that's not even capital gains yet. It's just a remeasurement, isn't it? And I'll end up with 3, and I pay tax on 3, which is 840. And then my deferred tax for the current year is on the land and buildings, 1061 and 1918, which is the 2979 that we saw, the market value, yeah. The original cost was 28, and so I have a temporary difference, which is 179, and it's taxable at 66.6, 28%, right? Because it's an increase in the fair value of an investment property. So then when I do 66.6 and 28%, which they show you here is what they do, they land on 33,380. 33,380. They do a calc up here where they look at the movement in deferred tax. And the movement in deferred tax is 5408. If you look at what that 5408 is, it is on the 29, that was the current year's movement, 66.6%, 28%. That's going to be that number. Yeah, you can check because the only deferred tax is on that investment property, isn't it? So the movement that I expect to see is the increase in fair value in the current year. And that's the 5408. Yes? And so then they say the movement in deferred tax is 5408. This year's movement, my normal tax, current tax is 840, so my tax expense 6248. If you get the number right, you get the marks, isn't it? Because what they asked you to do was a P&L. If you get the number wrong, you haven't done much in the way of a calc, isn't it? So then you will lose marks. But if you've run out of time, you've run out of time, isn't it? Try and do something that can try and get you to a number. So otherwise, you can see it's 3 calcs. Say it's the deferred tax calc, it's the deferred tax movement, and it's the current tax calc. And if you get asked to do the continuing and the discontinued, it's twice. So it's 6 calcs. It's a bit overkill, hey? But with discontinued operations, tax will always be like a bugbear that sits there at the back of your head because you have to split the tax between the discontinued and the continuing. Okay. I didn't even put in the note. But in your handout, the one I gave you, you'll see the note there for the non-current assets held for sale. And you'll see that they just do a story, and then they say, they give you this whole story here. Where's that Strubens Bar property? Here. They give this whole story here in the note. Yeah. And then they say that we have an investment property, and they put this as the fair value in the note because it's carried at fair value. We would ignore this. We would ignore this commission payable because with assets carried at fair value, I keep carrying them at fair value. I don't go to fair value less costs to sell. Yeah, and so they don't even talk about that in the question at all. Yeah, 18.5 marks. It's easy marks, the discontinued op. Really, it's easy marks. Yeah, so it's just a question of remembering the principle. The principle is, if I just go back to the very beginning, one of my components of my business is being discontinued. A major line of business or a geographical component. I'm not going to have it anymore. Either I've already sold it, or I have a plan to sell it, and that plan meets all that criteria, isn't it? About being formal, being announced, etc., etc. When that is the case, I must make sure that I disclose 2 P&Ls, one for the continuing business and one for the discontinued business. And I disclose those P&Ls for the whole year. And in fact, I'm going to add over here, because not only do I disclose it for the whole year, I also disclose it for prior years. All my disclosure that I would do would show that discontinued separate. Because I want my shareholders to be able to see what, eventually when this disappears and is gone, what will be the business that's left? What does it look like, this business that's left, isn't it? So the whole year, but normally you would not get asked to do comparatives, but the whole year and the prior years would get split out. And when we do discontinued ops, I don't care about the dates. Yeah? The dates at this stage are not important. Dates are irrelevant. When I did it last week, and I did the reclassification of the are relevant. No, man, I'm supposed to say irrelevant. Dates are irrelevant. Last week, when I did non-current assets held for sale, this piece, when I did the reclass and the remeasurement, their dates were relevant because it was important that I get the remeasurement right, isn't it? But for this one, dates here are not relevant. Okay, discontinued operations. Next week, we're going to do financial instruments. Financial instruments. And then when I get back from my break over Easter, then we're going to do Forex, and that's all we've got left to do. Okay. All right. You guys have got type letters from Unisa? Nothing. You should be finishing or wrapping up assignments predominantly for all of them. This one we wrapped up a while back already. You need to start doing some past exam papers, some questions. Yeah. So you need to start going and practicing questions. So for this one, for all the modules, there's a TUT letter with additional questions, which is not exam sort of type questions that are very individual. So just PPE, just investment property, just discontinued. And then there's another TUT letter, which is past exam papers, which is the mixed questions. Like you see in this question, we had PPE, investment property, and non-current assets held for sale, and a discontinued RPay, all in one question. So you must start going to practice questions. When we eventually start to do past exam papers, we're going to work backwards. So I'm going to do October 15 and May 15. And it's unlikely that we'll be able to do much more than that because our classes are only 2 hours. By the time we've actually done a question and debriefed it, we won't get through a 2-hour paper in 2 hours, isn't it? We'll probably get through a 2-hour paper in 3 to 4 hours. So we probably won't get much beyond backwards 2015. So whatever past exam papers you've got or they give you, you can do them up to 2015. If you want past exam papers, I've got tons, so you can work on. But you'll have lots of questions. I was just asking Evie now when I went downstairs to make copies, because Unisa was here earlier this week. They were here on Monday. Whether they said anything or discussed anything about TUT letters. But she says they didn't really touch on that. I don't know if you're going to get those TUT letters. Are you still getting TUT letters in the mail? Those stuck letters worry me because you don't get them, isn't it? When do you get them? Never. Or like once you've written the exam or... Yeah. So you're going to have to. Yeah. You're going to have to. You're going to have to print it or you're going to have to work off your tablet. I know some students are, this year I've seen working from their tablets. I suppose it's just getting used to it, is it? It's just a little bit of getting used to working not on paper, which is just we've got a preference for paper because that's what we're used to, isn't it? But it is also possible to work on tablets and not on paper, so that will save the environment a little bit. Okay. But you need to start doing some work. Then when we start to do those past exam revision, then I'm going to say, okay, here's a property with a reval, let's do it. And you're all going to look at me with big eyes, or I'll say, okay, here's an impairment, value in use, and fair value less cost to sell, let's do it. And you guys are all going to have big eyes. Because it's been so long since we've done it.